This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and today on the download, one thing I will say is that in the innumerable words of many a movie character that's about to be braced in for something, get ready. It's going to be a bumpy ride when it comes to investing in securities markets right now. Unfortunately, we are still seeing the extremely unsettling news out of Ukraine with the Russian conflict going on right now that is sending many a world market into a very tumultuous time. We're seeing Russian banks, at least a select few, being removed from the SWIFT program, which is the international system of being able to transfer money electronically. Think about it most analogous to the US Fed wire system or ACH system, which is a huge impact to their markets. Seeing the Russian stock exchanges trading down significantly in at least speculative market trading. They were shut down on Monday of this week, and as well as most of today as well. We're seeing the ruble, the standard currency of the Russian Federation, dropping almost 30% in value, and a large run on many cash withdrawals from many Russian citizens right now. So definitely a very tumultuous time specific to Russia and all the other US markets. We saw the Dow Jones or the NASDAQ last week dropping down to about 32,000 points and then rebounding up this week, but still on a rather tumultuous slide right now. So things are really all over the place right now. It's hard to kind of pin down one thing versus another, but still fighting things like high inflation in the country and a lot of other things. But to get to some specifics on the US market right now, Tesla's stock price seeming to come out of the weekend relatively stable, one of the few that is seeing some rather normalcy in its trade price right now. We are seeing quite an interesting thing happen from the telecommunications and video conferencing giant Zoom, which is actually what I record these podcasts on, seeing some issues in a recent call with the CEO that they are seeing a rather large slide in their sales and their last earnings report, also missing expectations by a relatively good margin. However, some areas that are seeing quite a robust movement are computer hardware. The CEO of Hewlett Packard seeing record sales and as well as blowing through their earnings expectations with their last earnings report as well. So definitely some big things to look for in computer sales, although some of this is being driven slightly artificially in my point of view, as the semiconductor shortage is still going on in full force. That is a holdover from the coronavirus pandemic that is hopefully starting to see its waning days here in the next coming, probably latter part of this year. Hopefully everything will be getting under control as the Omicron variant has significantly dropped in reported cases. So the markets for computer hardware kind of seeing the law of supply and demand, with a low supply and a steady demand, is going to make things sell a lot more when there's scarcity of a product. So we'll see if that normalizes with chip production and any type of sales come down. But as of right now, all things are looking green for computer sales and hardware in that category. Housing prices are expected to rise by almost 7% across the board. Now, single market updates are going to be significantly different than a lot of other places, but look to that coming in at a relatively good number, maybe even getting into double digits for the whole nation. The previous former Treasury Secretary Larry Summers is the one that reported on that 7% expected growth. Now, with regard to some other big movements, the CEO of heavy industries Toshiba giant out of Japan resigning. So that's definitely something interesting to look at if you are into tech and infrastructure. The giant Toshiba seeing a shakeup on the C-suite level right now with the resignation of their CEO. So something definitely to look at. The markets, again, right now are being nothing short of, a very nice way to put it, being bumpy at the moment. So keep that in mind when it comes to investing in when it comes to investing in securities and the open markets. And this also kind of brings up a good benefit of some of the inherent uh, good things that come from investing in alternative assets and things that are tangible, such as real estate, which aren't going to see such crazy price fluctuations like you will see in securities markets with world events happening, like what's the situation in Ukraine right now. Thank you for joining us today. This has been The Download. Today on the what is short selling? Short selling is an investment strategy that speculates on the decline in a stock or other securities price. It's a rather advanced strategy that is undertaken by more experienced traders and investors. Traders may use short selling as speculation, and investors or portfolio managers may use it as a hedge against downside risk of a long position in the same security or related one. In short selling, a position is opened by borrowing shares of a stock or other asset that investors believe will decrease in value. The investor then sells these borrowed shares to buyers willing to pay the market price. Before the borrowed shares must be returned, the trader is betting that the price will continue to decline and they can purchase them at a lower cost. However, the risk on a short sale is theoretically unlimited, since the price of the asset can technically climb to infinity. This is short selling, and this has been the What Is. Hi. My name is Alex Perny, and I will be the host and presenter today on this edition of the Alternative Investing Advantage podcast. I wanted to bring everyone some good information regarding, with prices being as crazy as they are today in many different aspects of the market. A lot of people are looking to utilize debt financing. I had a call with a gentleman this morning where we kind of went through a lot of procedural aspects of what it looks like to borrow money within a qualified retirement plan, be it an IRA, an HSA, a solo 401k, or things like that. So I wanted to kind of bring that to people's attention and also bring up what some potential issues with that can be. Because as when most people know, when you are investing or you are looking to buy something, let's say like real estate personally, it's relatively easy enough to understand what it looks like to get a loan or to borrow money to acquire something. It's not that hard to wrap your mind around it. And there are a ton of options out there for you. You can go down to, a local bank. Most people are walking distance to a bank that will loan them money on the purchase of a piece of real estate, or they can go to a friend and borrow money, or a family member and borrow money when it comes to wanting to acquire a new asset. Now, when it comes to utilizing borrowing structures within IRAs or retirement plans, there are a significant amount of aspects that need to be considered, not only just so far as the type of financing that needs to be used, but also some potential taxable situations that can really kind of work to the detriment of your qualified retirement plans, insofar that they are tax shelters. And most people use these as a ways to either avoid paying taxes with regard to things like Roth IRAs, or defer their tax payment down the road with deductible plans such as traditional IRAs, SEP IRAs, and simple IRAs. So definitely something really important to understand. So when it comes to actually borrowing money within any type of retirement plan, and I'm referring to IRAs, such as traditional or Roth IRAs, health savings account, education savings accounts, solo 401ks, SEP IRAs, or simple IRAs, you have to borrow money what's called in a non-recourse fashion. Now, this is a very popular method of financing when it comes to commercial or multifamily real estate, but a lot of our clients are invested in single-family real estate, or they want to buy other assets or things like that. And they may not necessarily be familiar with what non-recourse financing is, because it's certainly not as popular of a product out in the marketplace. What non-recourse financing means is that in the event of default, the borrower cannot be held liable for the repayment of the debt. The lender has to agree to only be able to come after the underlying security of the debt to be made whole. So in the case of buying a piece of property or a piece of real estate, that means that if the borrower, in this case, the retirement plan, can no longer make the payments or fails to make the payments, the lender can only foreclose on the property that secures the mortgage, that secures the note. So they can't come after the account owner personally. They can't come after other plan assets. So if the IRA owns another piece of real estate or the client has another retirement plan that has other assets, the lender can't come after any of those other assets. It has to only be made whole by the security to that note. Now, this is inherently a riskier position for the lender to be in. So the down payment requirements for these types of loans are typically going to be significantly higher. Now, in a more traditional borrowing sense, if you wanted to go borrow money to purchase a piece of real estate, there are products out there such as FHA loans and VA loans and other types of loan programs out there for recourse and personal borrowing that can get you down to as low as like 5% down on a piece of real estate, or maybe even lower. So if you're going to go buy a $200,000 piece of real estate, you might only have to put down $10,000 in order to secure financing for that. Definitely not the case when it comes to buying real estate or buying or utilizing non-recourse loans within a retirement plan. Most lenders out there are going to require anywhere from a minimum of 20% all the way up to I've seen 45% down on the property purchase or the purchase of any asset when they are lending on it for non-recourse financing. This means that your retirement plan is going to have a significantly higher down payment in order to be able to participate in that type of loan program. Now, unfortunately, since these are what are considered non-conforming loans and they are not going to be for your own personal residence, they are investor products, the amount of leeway that the lender has as to what they actually put in or their requirements for these types of loans can more or less be written by them at their discretion. Now, there certainly are lending laws out there that will, cap interest rates and things like that. But you have to understand that when you're trying to borrow money with an IRA, everything you do personally, so your personal credit worthiness, cash you have on hand, none of that really matters. You're going into this just with the actual merit of the deal that you're putting together. So lenders oftentimes will not only require a high down payment, they typically, for non-recourse lenders, if your IRA is trying to buy property, won't lend on anything that's going to be a rehab or flip. So if you're looking to buy raw land and develop it, or you're looking to do like a flip on a property and you need money for the rehab costs, typically lenders won't participate in those types of projects. Now, they typically will want to see that it's income producing, and they'll typically have ratios of what the debt to equity ratio versus what it's expected to rent for is. And also, they typically won't lend on anything that is four or more conjoined, because typically that will fall into a commercial property, and the types of loans and the requirements that most lenders have for that are going to change drastically once you get into commercial property. So understanding that if you want to buy real estate, and again, that's what most people are looking at when it comes to using financing within retirement plans to do, that the types of loans, these non-recourse loans, are going to be significantly different than what you've traditionally looked at when it comes to just borrowing money to buy a personal residence. Again, most people listening to this, probably have bought their own at least personal residence and are familiar with kind of the steps that go into that. You have to kind of really change your thought process when it comes to buying real estate if you're going to be financing it with the retirement plan. Now, that doesn't mean that these can't be profitable for people and that you can't make a good deal happen, but you just have to maybe change the segment of the market you're looking at. If you really wanted to look at and buy $200,000 properties and you only had, let's say, $50,000 in the retirement plan, maybe shifting and looking at the $150,000 properties might be a better fit for you. So I tell people, keep an open mind when it comes to utilizing financing to buy property, because the first crack at it or things that are attributable to non-recourse aren't always the most attractive, it can still help you get the foot in the door and make some good returns with your retirement plans. And especially with how crazy the securities markets are right now. I mean, we've seen, thousands of points shift just between last Thursday the 24th of February, and today is, as of this recording, March 1st. So if you want to see something that is, extremely volatile, pretty much the entirety of all the securities markets around the world are extremely volatile right now. And if you trade that off for maybe a higher down payment, a slightly higher interest rate, and also some other taxation issues that I'll get into in a moment with regard to financing within an IRA, it can certainly be a good shake. So being able to utilize retirement plans and finance within them in order to be able to buy assets that are higher valued than your cash basis in the plan is a powerful tool that people need to understand, but also understand that it's not maybe as easy as walking down to Bank of America or Wells Fargo or someone and just getting a regular loan, because non-recourse does have a lot of specific requirements around it in order to be done correctly. Now, another aspect that people need to understand with non-recourse is a lot of people will say, we'll do some research and come up with that, oh, I have to pay what's called UBIT tax on revenues generated by finance property purchases. And what UBIT is, it refers to unrelated business income tax. And that's kind of a misnomer that I see a lot of when people are doing research or someone writes an article on what that means. Essentially, if you finance the purchase of an asset within an IRA, an HSA, or an ESA, you have to pay a tax on the revenues that are generated from what is coming in on that particular property. Now, what is important to understand is that it is a relation to the actual amount of equity that you have in the underlying asset. So one thing to look at with regards to this is that if you want to have an IRA invested in real estate, and we'll kind of go through how this tax is calculated, what you'll need to understand is that the UDFI is going to be assessed to the income that is coming in that is not attributable to the actual basis of the property. So it applies to the portion of, let's say, rental income derived from debt. So for example, if the IRA purchased a property with 40% cash and 60% debt, that means that it's a 40-60 debt ratio. 60% of the net rental income is going to be subjected to the UDFI, or the unrelated debt finance income tax. So let's break this down, this example, further. So in order to calculate it, you have to take the average acquisition debt for the year, which is the average amount of the outstanding debt of the first day of each month. So if the IRA is paying on this loan every month, you take the balance of the principal at the beginning of each month, so 12 months, you add that up and divide by 12, and that's going to give you the average of the basis in the property. And then you have to take the property's adjusted value for the first and last day of the year and divide by 2. This average acquisition debt is divided by the average adjusted basis to find the debt percentage. And then you apply this percentage to the property's net income to find the UDFI. So that's all well and good. So let's say in this scenario that the property is worth $1 million, which is the current adjusted basis. You put down 20%, so you put down $200,000, and that gives you an 80% loan for the rest of it. Now, your average acquisition debt for the year is, let's say, about $800,000. And then the gross rental receipts for the year are $100,000 on this $1 million property. You have depreciation and other items that go into offsetting the debt and go into offsetting everything, and your net rental income is $40,000. So in this scenario, the amount of income that would be subjected to this type of taxation is about $31,000. And again, I'm trying to use big round numbers here to illustrate this, but your IRA does have to file a tax return in order to pay this debt. Now, again, that's something that you always need to calculate in and factor in if you're going to be financing a property purchase. Is not only do you have to find the correct type of financing, but you also have to have a tax return filed. And this tax return is using Schedule E of the IRS Form 990T. Now, do not confuse this with Schedule E of Form 1040, which is your personal tax return. The IRA has to file its own tax return on 990T. And one thing I will say, as far as a personal experience from doing this for 10 years, is make sure that if you have your tax preparer do a 990T for your IRA, that you apply for a discrete tax ID number for the IRA before you file that report. Now, keep in mind that you do get to use depreciation, write-offs, and expenses to help offset how much tax you would pay on that rental income. So the good news is that if you buy something and you're receiving income from it, that the amount of tax you pay goes down the more of that loan you pay off. So if you try to supercharge the loan and pay it off more with the IRA owned or the IRA held cash, then you can certainly get rid of that tax sooner. Again, this only applies to finance properties. So it's something very important to understand with that. Now, one thing I did mention is that this is what applies to IRAs, but unrelated debt finance, but non-recourse financing is the type of financing having to be used by all retirement plans. Now, if this isn't the best shake for you, and let's say you're a self-employed individual or you have some type of self-employed or solely operated business, one really powerful tool you can use to help avoid all of this complicated tax reporting mess is to use a 401k. So what we offer here at Advanta, and into the capacity of our self-employed clients, is the ability to do a solo 401k. So if you are a sole proprietor or you have an owner-operated business or a business where you don't have any common law employees, so anyone that works 500 hours a year over 3 years or over 1,000 hours a year in 1 year, you can set up a solo 401k. And if you utilize that plan to borrow money to buy new real estate, you don't have to pay any of those debt finance income taxes. So all that complicated mess that I went through with having to file tax returns and potentially pay taxes on the income received from that goes out the window with a solo 401k. So what I encourage most people to do, if you are new to this and you want to buy real estate and you're thinking, hey, I have to finance this property purchase in order to be able to do it, as I tell people, hey, take a step back and let's look at how we can try to help you avoid this debt finance income tax. The first way and the easiest way is to buy the property cash. But obviously not everyone has enough cash just laying around to buy property, especially with how expensive things are. We just saw the former Treasury Secretary Larry Summers predict that we're going to see another 7% increase, 7% increase in home prices in the US alone this year. And with regard to what's happening right now overseas, who knows what could happen with this kind of stuff with price increases and fluctuation. So again, I digress a little bit, but to better illustrate is to show that you have people may not necessarily have enough money in their IRAs or retirement plans just to go out and buy something cash right now, which is certainly understandable. So if you don't necessarily have the cash directly, to do something like that, you could maybe look to doing a partnership. Now, you can partner your IRA with other non-IRA individuals. So if you had a friend or a colleague or someone that you knew and you wanted to use your IRA along with them to buy a property cash and create some type of partnership, you can absolutely do that. And if the property is purchased cash, then you don't have to worry about utilizing financing, and you don't have to worry about paying any taxes on that revenue that's generated. You could also partner with other accounts that you have. So let's say your HSA could partner with your Roth IRA, which could partner with your traditional IRA or your spouse's account in order to buy the property cash. And you could maybe form an LLC or a trust that holds title, so you can just have one entity on title and create a partnership like that. You could also, in some scenarios, partner with yourself to buy something directly with cash. There's a lot of different ways that you can do that, but partnering is typically the first way that I indicate for people to get invested in real estate without having to utilize financing right off the bat. Conversely, you could also lend someone money. So if you've had a buddy that wants to do a project and instead of maybe buying it with them, you just want to lend a small portion of it, and then they go and find additional financing or, do whatever they need to do, you could lend someone money and still be involved in real estate as well. Another very popular way to go. But if you are in a scenario where you absolutely have to finance a property purchase, you can definitely do it. It has to be non-recourse. There are significantly higher requirements for the down payment and the utilization of the property that you have to be cognizant of, as well as tax implications if it is an IRA. So if that's the scenario you're in, typically the next question I'll ask someone to say, hey, or do you have any type of self-employed business? Do you have an LLC that you use to hold your other rental properties? Do you have, do you sell widgets on eBay? Do you have anything that can qualify you for setting up a solo 401k, which would essentially help you to eliminate the debt finance income tax requirement for being able to finance these property purchases. That's really kind of the 1, 2, 3 scenario that I go through with a lot of people in order to help find a good fit and make sure that they're not going to get, into a situation where they're, maybe in over their head if it's their first property purchase, or at least help them to avoid more taxes than they want to be paying with something like this. So again, very, very important information, especially with how expensive things are getting out there. If you want to learn more regarding specifically how to finance property purchases in IRAs, we have a lot of great things. We had a gentleman from Titan Bank on the podcast a few weeks ago that specializes in doing non-recourse loans for IRAs and different type of associated strategies. So I would encourage you to check that one out. His name was Ryan. Again, Titan Bank was a good one to look at. And if you have any other questions, I always encourage people to contact me directly. It's really kind of a cool thing that you can do with this, but also is rather a complicated tool as well. So remember, if you want to finance a property purchase with a retirement plan, it has to be non-recourse. If it's within an IRA, anything other than a 401k, you're going to have to pay unrelated debt finance income tax, or UDFI, not UBIT specifically. UBIT is unrelated business income tax, and the two terms get interchanged a lot. So just be aware of that. Potential taxation, non-recourse debt, different types of accounts are exposed to this type of tax. And if you have any questions, give us a shout. My name is Alex Perny. This has been an edition of the Alternative Investing Advantage podcast. Thank you so much for joining us, and I hope everyone has a great day. Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.